This is their own money. And I think all of this comes down to people. It's about you. If you're going to be conservative, if you want to tell your customers, it's not about making money for your customers. It's about investing wisely so you can grow your savings. So it's not about this quick money. And if people can understand that, then maybe they'll be able to trust you tomorrow if something, in the short run, something is going wrong. All of this, what does it increase? How is it value added to you? And I think what it is that, as we call it, WTP. WTP is a term called willingness to pay. When you're going to give a value-added service, when people trust you, they will be willing to pay. And that's what we've seen over and over again. I studied a lot of cases on this. It's called WTP.
Yes, okay. Thank you, Aditi. I think as a surprise move, you've already given the most basic impact of what we wanted. So now I will ask the other panelist. I'll direct this question to Puneet. Puneet, what I would like you to share with us is, what does an IFA have to do to make the existing clients realize that mutual funds is a great investment vehicle? On this point, if you could just share.
I think at this point in time, the first thing that the IFAs have to do is believe themselves that mutual funds are a good investment vehicle. Because over the last several months, I've heard many of our partners actually talk about the negative returns that the markets have delivered over the past several years. And I think there is a bit of a crisis of confidence even within the mutual fund distributor community. We're seeing high interest rate alternate products, particularly from the banking sector, whether it's tax-free bonds or fixed deposits, rearing its head. Now we all know that that's not a sustainable competitor. Interest rates have to come down. Infrastructure spends will not always be funded from retail flows. So yes, we have a peculiar situation in the last couple of years, and particularly in the first quarter of this year, where the alternate investment products are actually are very popular and attractive. But that doesn't mean that the mutual fund industry is going to wither away or is going to fall by the wayside in the face of such stiff competition. So I think having confidence in the product that we are all associated with is very, very critical. And a lot of that confidence, whenever I talk to people, even when we watch cricket, you have heard the commentators talk about body language and how it's really about your body language translating into an influence on the other side. And I think that is very, very important. It's very important in every sphere of life. The other thing to do is to say it the way it is. If funds haven't made money for the last 3 or 5 years, that's fine. We've seen that happen not once but many times in our investment history, that there are only, somebody was mentioning, 68 to 70 trading days in the stock market over the last many years, that if you had stayed invested, you would have made money. The rest of the days were just, floating with the flow. So if you're a longer term player, mutual funds is the only real alternative that you have. But you've got to be honest and say to people who don't have the ability to wait that long. If it's a very, very senior individual who's well into his winter years, to say to him that this is the right time to get into mutual funds is probably stretching the credibility of the advice a little bit. So I think the key messages are you've got to make sure that you believe in the product yourself. And when you start believing in the product yourself, you'll find it a lot easier to communicate with your clients. The second key message I would leave you with is just be very honest. There are people who will like the message that you're delivering, but equally there will be people who will like to receive a very different recommendation, which is to go into fixed income, particularly people with a very low risk profile. Now, just coming back to the earlier question, and I just wanted to add to some of the observations that were made in terms of how do you actually go out and retain a loyal customer base. I think the WTP example was a very good one. But for WTP to actually work, the customer needs to know what you stand for. What is the value that you bring to the table? And that could be focus, it could be integrity. A slight observation on integrity, I think there was a time when integrity was very important, it still is very important. But is it the differentiator today that it was 5 years ago? I don't think so, because the number of credible players that you have in the system today are increasing. There are many, many players who are very, very strong on integrity, reputation, brand. And what you got to really remember is that your customer has to see the value that you bring, which means, and to be able to see that value, he has to understand, or she has to understand what you stand for. Are you a fixed income player? Are you an advisor? Are you an executor? Are you a full service? Are you just a locational convenience? Are you administrative convenience? There is a whole range of things that you can actually choose as your differentiation. But that differentiation has to lead to definition of what you are, which the customer needs to understand very clearly.
Thank you, Puneet. What I would like to also ask and put forward this question to Kailash is that the cost of retaining a customer is 1/5 the cost of acquiring a new one. Now, if this is so true, why do people stress on acquiring new customers?
I think the charm is always to say that I've got X number of customers. To put it very plainly and simply, that's one of the key reasons that people say that I am going on an acquiring spree. But I'd just like to add to what Puneet said earlier, and then attaching this. Whether the cost is 1/4 or 1/5 or 1/6, that's statistics are more critical. I think many a times we get confused in terms of when you say retention of customers, that we have to do some crazy things, very big, or something very macro, or something which can cost money, or to retain customers. Actually, what customers need is just simplicity. So if you are able to give a simple message to customers, if you are able to talk to them in their language, if you are able to be with them when times are bad, and I think that's a point which has been covered, it's actually that is what they really believe in. And when you talk of acquiring customers, it's far easy to acquire customers by getting a happy customer. So if you have a happy customer, he gives you 3 rather than you going blind and then trying to get more customers. So if you look at the trade-off which is there, customers who come in through referrals would possibly, the ratio may be 1/8 of acquiring, or I don't know the statistics, I'm just taking a wild guess out here. But I like to quote an example to you on how easy it can be to retain customers. All of us are interacting with clients, and not necessarily the client is only doing business with you, because he may be doing business with you only for mutual funds, but possibly some of the other products he may be doing business with somebody else. And there was this gentleman who used to service me long back, I'm talking about 10 years ago, and I had shifted to a new city at that time, and he said that what kind of help would you need? Do you require a chartered accountant? I can recommend to you some good chartered accountants. Why don't you meet up with them and see whether he fits what you would like to do? Now, if you are come to a new city, and I'm sure that many of you would come across professionals who move cities, that's a big service, because I don't know people out here, and they believe that this person is really interested in doing something for me rather than only interested in getting my check. So possibly in the first meeting, there was no discussion of how much money can you give me, or what is it, this is what product I'm selling. He's just trying to understand the person better and engaging with it. There's another gentleman where I can quote, and this is a pretty interesting example. When he was engaging with his client, he realized that every time he asked the client for some documents, he realized the client took a lot of time to get the documents out, because he was not structured. So the client used to keep the documents in different places. So he just told the client one day, sir, if you don't mind, can I just have a look at how you keep your papers, and can I just take them and then return them back to you, so that I have copies of it at my end and I don't have to trouble you time and time again. So when you gave the file, it was all messed up, and then when it came back to you, it was bound year by year. Everything was put in order with a covering note saying this belonged to this year, this belonged to this year. Now just imagine this person, and I know this gentleman, so I'm telling you, must have referred 50 clients to him. He did nothing, he didn't get a single check. But customer retention at its, I think the best is what he ended up doing. So if this guy gives 10 customers to you, is it not acquiring customers by retaining a customer? So I would rather put it that you can really go ahead and acquire customers by retaining customers rather than just going on an acquisition spree, as we call it.
I can just make one observation here, that this is a message that most companies don't understand. If you look at airlines, if you look at mortgage companies, if you look at loan companies, they'll have better deals for new customers whilst the previous customer base continues to pay a high rate. It's now changing, but this is not a message that is widely understood. And the sooner people understand it, the better it will be for both the consumer as well as the person serving them.
Thank you. That's very interesting and good observation. I'd like to ask another question is that most of the IFAs do not promote the liquid funds as it is not remunerative. Can a tech solution address this issue? Who would like to take it?
You want to go?
I can take that. Absolutely. I mean, let's look at it honestly. I think there is a lot of paperwork involved in our industry if you want to do things offline. And for the amount of money that you end up investing, or a retail investor ends up investing in a liquid fund, possibly the remuneration is not conducive enough to have a form pickup, etc. being done. But if you use technology, let me tell you, you can change the landscape, and possibly the entire administrative cost of your office can just be covered by liquid funds alone. If you ask questions to your customer, and you know, it's a different way of asking a question. Rather than say, I'd like to sell you a liquid fund, if you go to a housewife, and let's just assume that you want to ensure the husband is not really giving you enough time, enough grief, and if you go to a housewife and tell the housewife that, ma'am, I have a solution for you wherein without really doing too much of liquidity control at your end, I think I can take care of the salary for your maid servant for the next 3 months. If you go to a SME person and you talk to an SME person, and today you know that all the corporates, whether they're SMEs or large corporates, are bothered about their cost structures in terms of the expenses which they are incurring. And you say that you can manage to take care of possibly 2 months of electricity bill. He's going to ask you how. And the moment you say that, sir, you have money lying in current account or savings account, and if you park this money in this product called a liquid fund, and this is my platform, and hence you are a tech savvy person, you don't need to really even call me or call my office. Every time you have surplus, you just put it into this fund which we have identified, and when you want to withdraw, if you put in the order before 12 o'clock in the afternoon, next day by 10 o'clock or 11 o'clock, the funds will be in your bank account. Just imagine the power it has when you are trying to tell them that you are helping a person manage your household expense or manage an office expense. I think the way you put it is very important, and then you can't really send a person, a runner boy, to collect a check of 1 lakh or 2 lakh where you learn 50 rupees. So that's something that can be proliferated as we go along, and really it can scale up your business to new levels, because there's a lot of money being parked by individuals in savings and current bank accounts, and as you know, current accounts actually earn you 0. So any return given by a liquid fund, even if it falls down to 5%, is better than 0.
That's wonderful. In fact, it's one of the nice innovative ways which we can, get across to our customers. And the last question I'd like to, add on to what Aditi mentioned, like when we are talking of customer retention, she mentioned about the principles that you have. That means what it says is it's not that we have to plug and see that all the customers are retained. There could be a change in the customer profile, or there could be a change in your own profile. So instead of the word plug, it could also be the word filter. Perhaps what we need to do in customer retention is that we can even filter the customers that we would like to have, rather than just retaining all of them together. So I'll ask Puneet to throw a few questions.
I think that's a very important aspect of customer retention, because you could have started out as a company which was serving a very large range of customers, and in today's environment you probably find that you are better off both for the customer and yourself focusing on a certain segment. So sometimes it's actually important to let some customers go, because that's not part of what you want to serve or what you want to do. And that improves your competitiveness in the chosen segments that you want to play in. I think I'd agree, that is a very, very important aspect of trying to make sure that you have the capability to focus on the clients that you really want to serve.
Okay, thank you. Would Kailash, Aditi would like to talk?
Actually,
Yeah, please.
I don't know if you have anything to add to this, Kailash, but there was something that actually came up to me with the previous question. With your permission, can I just talk a little bit about that? When we were talking about liquid funds, something came to mind, and I said, and the question even before that talked about, how do you get everyone more interested in mutual funds in general? And I've written this down, and I feel it's because everyone perceives mutual funds to just be about equity. So when the market goes down, they're like, the mutual funds did badly. Mutual funds were bad. First of all, people don't realize that you need to benchmark them against the market if you're going to do equity funds. Very important to talk about the market. This comes back to honesty, it comes back to integrity, it comes back to more than that, just being upfront and clear in the beginning. Let people know that. It also means, what about people who are apprehensive to go into the market, to go into a mutual fund, don't know? Talk to them about liquid funds. Talk to them, tell them, why don't you dip your toes into this thing first? And also remember that once they finish their KYC and all of that, they get into a liquid fund, they realize what this means, they realize that their money is not being taken away by anyone, they can start trusting you, they can start trusting the mutual fund company. Slowly, maybe you can talk to them about equity funds, but explain the risks to them, that is going to be a little higher risk. So it's a great entry strategy for you. Second thing people don't talk about is the tax advantages when it comes to a liquid fund compared to putting the same money in a fixed deposit. We don't know now how long these tax advantages are going to last. Maybe they will next year, maybe they won't. We don't know. These things keep getting postponed. There's a lot of speculation. But for now, people can save money. So again, be upfront. Hey, listen, for a year you can still save money. Why not do that? So it's important to explain to them and let them dip their toes in it. Where technology is concerned, of course they can help you. There are many mutual funds now that have online trading available. Explain to your clients about that. A lot of mutual funds allow the FA to put their ARN code, so it's not like it's going direct also to the mutual fund. It just makes life easier for you all. So I know, for example, DSP BlackRock has it. I'm sure that I know there are a lot of other mutual funds that also have that. And the other thing to really explain to your clients is that if you're going to get into an equity product, it's like looking them in the eye and saying, hey, you're going to get into this. Here's the history. Stocks have beaten bonds over the long run. We all know that. But please, please fasten your seatbelt. I am no God. I can't tell you tomorrow if there's going to be some war somewhere and something's going to happen. Perceptions may go haywire, but you have to fasten your seatbelts, and equity is for the long run. Do not, it's almost like telling them, please, I will talk you through it, I will talk to you, but do not think of getting out of, let's not panic till 5 years. And in the more sophisticated markets, people already know this. In fact, they come to us, we have funds that are floated outside the country, and people come to us saying, we said, what is long term? And long term is, for them, short term for them is 10 years. Some of them. So some people know and they're more sophisticated, okay, Indian, it's a new market, but it's your job to educate them.